Hi, this is Randy Finney with Right Side of the Chart, and today is Thursday, December 2nd, 2021. It is 3:24 Eastern Time as I'm starting the video, so a little more than half an hour to go in the trading session, and I figured I'd do an update. Now, yesterday I went into extensive detail on the broad markets, covering various charts from short-term, long-term, all the way out to the monthly charts, and then talked on a whole bunch of different breadth indicators. So we won't do that. It won't be a long video. Here's what we'll cover: just updates on some of the recent trade ideas as well as the markets. I'm going to go through the equity indexes real quick. We'll just probably stick with QQQ because that's the one I'm focused on the most right now. Um, if I see anything significant in the others, I'll let you know. But right now, let's just watch this one, or at least cover that in the update. And I want to do a quick update on the VIX as well as the Skew index. I made mention of the Skew index yesterday, which measures it's the cousin, if you will, the VIX. It uses put versus call buying, but instead of using at the money puts and calls, it uses the out on money strike prices. So we'll get to that in just a second. All right, let's just start out here with QQQ. I will not spend a lot of time only because I gave you a post this morning, and absolutely nothing has changed since that update I gave you this morning. And that was, I give you two charts. This is the one I've been covering in recent videos over the last few weeks, and that we had taken out. I was waiting for a break of 390 to trigger the next objective short entry, and that's what we got today. We went down, and we've been back testing it all day. So the market doesn't always give you so many objective entries. A lot of times you go for a back test, it's quick, and you get a reversal. And look, let me say this: there's no guarantee that we reverse there. All I can guarantee you is it's very objective, in my opinion, to short there. And you can see, again, this 60-minute chart, every single candle since that opening candle we went down has tested that level. So say what you want about it, but I think you'd find make a hard case to argue that that is not a significant resistance level. And so again, nothing's changed in my view. I think we'll go back down. Got a little flag action going there. You have an impulsive move down. That's called the flagpole. This is called a bearish pennant. You can sometimes takes the form of a flag or pennant. Same thing. Just pennant gives you that little triangle shape instead of a even flag like that. And then you just take the distance of the flagpole, the length of it, add it to the top of the flag before it breaks down. Now keep in mind it hasn't broken down yet, and that'd give you your measured target. So again, whether it happens, plays out or not, I can tell you that this is an objective shorting entry. And if you want to play it safe, you can wait for an impulsive breakdown below the flag. Now, being that there's half an hour to go in the trading session, it is possible that this doesn't break down until tomorrow, or breaks down right before the close. Some traders, even myself at times, don't like taking breakdowns, breakouts just before the close because they can prove to be whipsaws. Then market shuts down. A lot can happen overnight. Okay, with that being said, but one other option or one other possibility is you can gap down out of the flag, and then that denies an objective short entry if it's too far down out of the flag. So we'll see. Anyway, just pointing out what I see. You trade it as you want, and you know, if you're bullish, you can use these same levels, support and resistance levels that I give you, to buy dips. Or let's say, for example, this proves to be a false breakdown, this break below 390 today, and we get a solid recovery back above it. Well, then you may see some stops get hit by shorts that are covering their positions, and you could run back up to the next resistance, which is 401. All right, but that's where I think we're going. And like I always say, the charts are dynamic, and so is my analysis. So if something changes, I'll let you know. All right, the other variation of the 60-minute chart I gave you recently had this head and shoulders topping pattern on the 60-minute chart, and that was our neckline right there, which was broken today, also triggering an objective short entry. And in addition, we also broke down below the uptrend line. So there's, you know, gosh, that's what, 3 variations of QQQ: the head and shoulders, the other board I just showed you, the first chart I showed you in this video, and then this one that has this uptrend line that comes off early October, beginning of October back there, and that is breakdown, and there's that same little flagging action. And as I mentioned in the post this morning, you take the measured target for the bear flag, and you take the measure target for the head and shoulders pattern, and they both come in right almost exactly down to that 370, 376 level. So no guarantee it'll be hit, but like I said, a lot of things pointing that way right now. So all we need now, guys, is a nice reversal off here, whether we get it in the last half hour of trading today, whether it comes tomorrow, or look, even if we bounce back, remember, support once broken becomes resistance. So that's why this neckline and that 390 level, both are resistance. We're at resistance now, but if we pop it, you still have then a back test of the trend line, which could cap any advance. And if we go much above that, well, you can make a downtrend line off the recent highs now, and each and all of these are levels that, if taken out, are likely to bring in more buyers or cause shorts to cover. So you really don't want to see much above that. That would also, by the way, that downtrend line I just drew and the uptrend line, a back test of those would come in roughly together. And so anything above that, then you have these previous reaction highs, and the way it works is the bulls, or the bullish case, each one of those that are taken out, they get a check mark. All right, if and when those are taken out, and then that opens the door to new highs. Otherwise, we get a rejection here, especially if we take out the recent lows. And if it's impulsive, that's what you want to see coming out of a flag. The nature of a flag, by the way, I told you it'd be a short coverage on the indexes, but I'm still talking. One of the things about it is the flagpole has impulsive volume. I think you can see, you know what I always say, I think you can see them, but let me turn it up, and then you will see my volume bars down here. That's what you want to look for. You want to see impulsive drop on the flagpole, and then you get an area of a kickback, a little brief, a moderate rally on declining volume. Again, that's the nature of a flag pattern. So you have right now the pattern, or the bearish pennant, but you don't have the sell signal, which is going to come on a breakdown below it. Okay, the VIX is waking up a little bit lately. We've been diverging. We've had this wedge here. We've had pops. Talked about it. It's not like an EKG, but recently we came up here, and I said if we take out, that was a level I highlighted last time I did an update on the VIX. We were at 28.76. That's these two previous reaction highs. We took it out, and then we popped up to the next resistance there, which 31.20, and we're basically back testing that as well. So a case could be made if you want to go into VIX call or VIX futures, or the calls on the options on the futures, or the VIX ETNs are pretty simple. You can make a case to buy there or in a pullback there. But again, align any trades on the VIX first and foremost with the indexes, because if this market goes on to new highs, you're going to see the VIX come back down, and this will just prove to be another spike. But what is different about it right now is, the VIX bottom back here, back in late June, early July, and here's a low, and then we put in another low here. It was a higher low, and so far you can see this. We have a series of higher highs, so it's potential. At least if you look at it that way, that could change. But as of now, it's early signs of a trend change in the VIX. And so anyways, that we could shoot up there to the next level. Trade that. UVXY is one of them. VXX is another one. I'll give you targets on this. Actually give you targets today on the 60-minute chart. No, I must be thinking of one of the other inverse ETFs like SCO. Those are the targets from before. Oh yeah, I did mention the other day too. I think they still hold and will play out this time around if we get more downside in the market. All right, next up, let's talk about the Skew index, and that would be, let me cue it up here, right here. Okay, so what is a Skew index? Well, the Skew index measures potential risk in the financial markets, and it's a lot like like the VIX. It can be a proxy for investor sentiment and volatility. I'm loosely reading this off Investopedia. By the way, guys, you can just Google search Skew index and you'll get the definition. So it measures tail risk in the S&P 500, and like I said earlier, the primary difference between the VIX and Skew is that the VIX is based upon implied volatility round at the money strike price, where the Skew considers implied volatility from out of the money strikes. And if that all sounds Greek to you, well, options have to do with Greeks, just it's a whole different thing there. But they basically, the Skew values generally range. Again, I'm reading from the historical definition on Investopedia, or historically I should say. It ranges from 150 to 500, where the higher the rating, the higher the perceived tail risk and chance of a black swan event. A Skew rating of 100 means the perceived distribution of the S&P 500 returns is normal, and therefore the probability of an outlier return is small. In other words, low risk at the time. You can look down here. Well, I got to zoom in for you. I'll do that. Zoom, zoom, zoom. Make sure I'm in the. Yep, I'm in the video here. I didn't want to make sure I didn't zoom outside the screenshot. There it is. So you can see we're going back here all the way into the 90s, and these show you, things that happened back then: start of Iraq War, Asian financial crisis. By the way, there was a big drop, 20-something% at least back in that was in 1998. So it worked. It's worked in a lot of instances, and again. For the reasons I just told you. So if you even recall, the last big spike, now over the years, you can see one thing I will note, you have to acknowledge that, it's been trending higher. So, I always I just read you the definition or about the skew index, but I look at a chart, and if somebody tells me, well, reading 150 is high, well, I look at that and say, yeah, that used to be the case, but you know what, Investopedia or whoever, you may want to rewrite that article because of times have changed. Financial markets. This is ever since the financial crisis, there's just been a not even implied, more of an explicit understanding that the Fed's got the markets back. The Fed refuses to allow recessions, the natural process of recessions that flush out, inefficient companies and businesses. We've had those boom and bust throughout times, but anyways, the Fed for whatever reason refuses to allow stock market corrections or recessions, and they'll come in with everything they have. Not to say we haven't had any, but they've been quick. And so therefore what you're seeing, where I'm getting at, is times have changed. So now all we know is these spikes, it goes higher and higher, but what I can show you, and you can see, I believe you can see to the right of the screen, you can look where we are right now, and we have some insanely high readings. In fact, we just came off one. And again, that spike back here, that was August 2018. You guys remember that? I remember it well. It was a big Q4 drop. It started in the last, went down, the market plunged in the fourth quarter of 2018, over 20%, so technically a bear market, most of the indexes that was. And again, there was a spike leading right up to that. Perfect timing to say, hey, something's wrong, and it did. And that was, technically based more so, and that's why they don't have a little marker here talking about what caused it to spike that time. I addressed that at the time. We had clear sell signals, divergences, everything else. We were in it short at the top, and that correction was forecasted by the technicals, but the press had a very hard time assigning a cause for the drop. They just chalked it up to kind of randomness. But anywho, and that's why I just want to explain why they don't have the explanation for that spike there, nor do they have one here. Obviously, there's been so many things going on since COVID hit. It's almost hard to pin any one instance. But bottom line, you can see where we're at right now. We're at 155 on the skew. So that's nosebleed territory. Any way you slice or dice it. So I just wanted to share that with you. And what does it mean? Again, there are no guarantees, but what it implies, or my takeaway from it, is that one of these seemingly minor tops that we get on a 60-minute time frame or a sell signal on the daily in a correction like it's underway right now could prove to be the beginning of a much bigger drop that starts to accelerate and the bottom falls out fast. Maybe, maybe not. Again, there have been spikes in the skew where nothing happened. I will point that out. I've studied it in the past. But it just kind of tells you, hey, you know what? Just in case, if I've got, your 401k is fully long in the market, or you're long on margin, and you're convinced this is the greatest bull market in history with a lot more upside to come, you just might want to consider where you're going to put your stops, or how much of your positions are you going to reduce, or are you going to hedge up if and when that happens, because the market, that's one thing it's always done. I don't care if the Fed's in there or not. In recent years, this market has been plagued by very sharp and fast drops. So when it decides to finally change course, change trend, in just a matter of days, especially weeks, you can easily see the market wipe out months, sometimes even years of gains. So that's it. That's my takeaway: is don't become complacent just because everything's hunky-dory right now, at least in the stock market. Crude oil, I'll start with USO here. It's one of the more popularly traded ETNs. No leverage, so it's not going to decay over time like SCO and some of the others. Daily chart, yeah, we broke the trend line. We stopped at that big old gap back here. There was a huge gap from 2020 right there when COVID started to wreak havoc on the markets, and that was the end point for the rally. Then we broke the trend line. But as I mentioned yesterday, and we had a bounce trade, and the minimum bounce target was hit. I'm going to get to the futures in a second. That's where I laid out those targets. But I wanted to point out yesterday we had divergence on the futures, but not on USO, and now we have it 60-minute chart on USO. So again. We were able to milk out the bulk of this 21% or so, over 21% drop in crude oil, being short, early on, and all of the big drop right there. Now it's time to maybe lighten up, or if you're aggressive and you want to take a counter trend long, it's a 60-minute divergent low. However, I still think we're going lower over time. Let me get to the futures here. Let's start with the 60-minute chart. So here's the one I laid out yesterday. We were right here, and we had this positive divergence, which I pointed out. That point in time it was right here, and it led to a bounce. I had a minimum target, was this red line, which is a Fibonacci retracement level right here, 69.08. It's a 23.6. That's the minimum fib retracement level typically on charting programs, and we hit it almost to the button. That's where I said active trader was like a 6, 7, 8%, maybe 8% bounce off the lows, and so active traders could have taken profits. Or at least raise stops so you didn't lose any money and you locked in profits. And then we had another drop down, but see what that drop did. Let me just pull it in a little tighter here for you. All that drop did is it extended the divergence, put in another, actually it's the same divergent low, it's just larger now. It's the same divergence lines down below. And so we've been rallying since. And where does this project to? Well, look, we had a reaction on the initial tag, my first target. That's why I list multiple targets. Each one is a level. It could be the final stopping point. Sometimes it is, but if I list multiple targets, ideally usually you're going to get a reaction on the first one. So that's all that is, a reaction. So we could head up here. This is likely if the stock market holds up and moves above, tears out those bear flags that it's working on right now, moves above them, takes out the resistance levels that we're back testing now. This will be the most likely scenario. I think you'll have a lot of people coming in buying that 21% drop in crude oil. However, should the bearish equity scenario play out, this rally in crude and these divergences may fizzle out, and if they do, that's a pretty darn bearish technical event, because these divergent lows and divergent highs, especially in a bull trend, a primary bull trend, which crude is in, it's those 60-minute divergent lows that are usually the catalyst for the rally to the next high, next all-time high. So keep that in mind, guys. So whether you're trading it, look, it could go either way. Just don't get married to your trade, whether you're bullish or bearish on it. Use stops. If you got in, you bought it today off the divergent low anywhere in here, maybe have your stops ratcheted up if and as it goes up. If you want to short again, just don't underestimate how far it could go up. There's a potential trend line here. I have that max bounce target zone from 71.20 to 72. That's the 20. By the way, that's the 38.2% fib, and then price resistance up there. Okay, I was flipping over to this other charting program to show you the longer-term chart of crude futures, but I already had it on palladium, and I didn't mean to cover it in the video, but I should, because I'm watching this. We have nice divergent low in palladium right here. It was mentioned as a short trade on the site back here, and I said I was longer-term bearish, expected a lot more downside and still do, but back here then I covered that short, posted as a long, and we caught that rip, and then I said I was only looking to catch that rip and get out, which I did. Figured we'd get another leg down, which we did. So I'll maybe revisit that chart after this. Let me get back to crude. Just want to say we have bullish divergence here. There's some support, mild support right there, but strong divergence on the indicators. So this one is looking interesting, and I'm still liking gold. I think gold's going to likely take off soon, and this one could follow and have another bear market rally. But let me get back and give you that crude chart that I want to show you. Okay, here's the one I've been working off for quite a while now. This is the daily chart of WTIC. Same thing, crude futures. Stock charts just gives the symbol $ WTIC for West Texas Intermediate Crude. You have a nice, very nice support level back there, all the way back in 2015. Broke. I've covered this a million times lately. Back tested there, rejected, and I also highlighted all these divergent highs. This is what we're looking at here. Look at all the divergence lines, and look at these drops. Just look how much we dropped each time we had a divergent high. Even that one was little. So that's about the smallest drop. These were bigger divergences. So what I think is happening here, I believe there's more downside. Let me just say that. Whether we bounce or not, whether those 60-minute divergences get burned through, I told you what is likely to determine that. But I think there's still more downside based on this two things. Not only the big divergence that we had here. That in itself, again, we're going to see this again? Hey, anything's possible. You know, the world could shut down again if COVID or the next horrible virus comes out and starts scaring everybody. But I'm not looking for that right now, but I am looking, I think, for more downside, considerable more downside in crude, maybe all the way back down here to that 42 level. We'll see. But again, so we had the negative divergence like we had all those other times. And then as or more importantly, we had that big fake out right there. Remember, that was the big level, big level. You know, I put a short on crude when we hit it last time there, and it played out. When we put in a divergent low and we went up, and all we did is popped it, made a marginal new high, but then that failed. And you can see, and I always talk about this, you know, how that's pretty bearish when you have a failed long side breakout because all the stops are hit. Let's see, I'm trying to get this over to you there. This is going to snap. I'm using a big monitor that's going to snap this if I let go. I'm going to have to put that back. But you can see where the big drop is after the divergent high on the right of the screen there. And that is what happens when a breakout fails. There's all those bulls that bought the breakout are having their stops hit, and then the shorts, you know, are like sharks that smell blood in the water, and they're piling in. All right, so let me get rid of that. Well, it went away. Let me go back to... Since I brought it up, even though I didn't intend to cover it, now some of you might have piqued your interest on palladium. Futures have rolled, so I'm not going to go over that chart. Well, I'll show it to you right there. There's palladium futures 60-minute chart, positive divergence on the 60-minute chart, and we've got some... I just had to update this chart because they rolled recently, the futures. There it is. It needs to pop that about 1777 level, and it might be able to run if that happens there. Targets, well, I can give you some now. If you're going to trade the futures contract, I'm going to get to the ETF in a second for you on platinum. Let's say max target. I'm just kind of roughing this right now, so I'll revise this if this one starts to play out. But that'd be my max target, about 2143. And then this one does have an ETF for you, and that's PALL. And that one was back here. What time frame? There it is. Yep. Posted as a short entry in the August 31st video right there. We went down here, and at this point, we had bullish divergence on both the daily and the 60-minute chart, and we were at support, that 172.11. So there I highlighted as a bounce trade, and we got a nice bounce out of it. I mean, from there, bounced about 18%. And so, and I stated at the time, you know, I'm still longer term bearish, but looking for a bounce. And that's the thing, even if you're a trend trader, who doesn't want to sidestep a 21% give back? That would have probably stopped out a lot of traders. And that's why I kind of consider, you know, I wear multiple hats: investor, active trader, swing trader, day trader, trend trader. But even when trend trading a position, if I can make the case for a pretty good bounce, which like was made back then, I'm going to try to sidestep a 21% give back and then recycle back into the position for the next leg down. At this point in time, like I said, we have positive divergence. They're unconfirmed, but they're pretty strong. So we might get another counter trend rally in palladium there. So consider that a trade idea for you. Okay, next up, natural gas. There's another one. I'm longer term bearish, but I think we could get a bounce. In fact, I thought we could yesterday, and I mentioned it here because we had positive divergence and we were at the 4486 support right there, but we didn't bounce. Well, we had a reaction, but it wasn't much. Now we've gone down to my next level, which is even better support. Why? Because there's more reactions from below, more reactions from above. So we're at support and with positive divergence. It's still unconfirmed. It never got confirmed yesterday, by the way, and it's still unconfirmed, meaning it's hanging in there by the skin of its teeth, at least on both indicators. What do I mean by that? Well, prices are making a lower low. And in the RSI, which is one of the momentum indicators I like to use, it's making higher lows. So that is positive divergence. But here on the PPO, we're flat. This line right here, and it is positive divergence. It's called what I call flat line divergence because you have lower low in price but equal lows. In fact, the slope of that line is a perfect zero, meaning it's not sloping upward, angled upwards or downwards. So it's still there. But if we go much lower, that's gone. Now, does that mean they can't rally? No, but if we go much lower, you break support, and unless you get a quick whipsaw back through there, or a whipsaw, as long as it's just marginal, you're going to burn through the divergence, and then probably on both indicators. So, look, keep it very simple. Right now, just as it was yesterday, even though that one didn't pan out, I can make a case for an objective long entry here. And trading's all about just calculating, the risk and reward. So, okay, you go long at $4, 410, 455 is the level. And minimum target would be back to 4,486, but I think we could probably pop up to here, 4,823. So what does that mean in percentage terms? Here's how I calculate a trade or analyze a trade. 20%. That's right about 20%. So therefore, you can use a 6-7% stop loss and still give you a good, nice 3-to-1 risk-reward ratio down there. So that's it. And you might want to even keep it tighter. If you use, let's say a 4% stop loss, and you have a nice 5-to-1 risk-reward ratio if you're targeting that level. So there's another trade idea for you. And that's natural gas, but I think after that goes, if we get a pop or not, I think we're still going low over time. Let me show you why. Okay, the long-term chart of natural gas that I've been showing lately is this one here. It's a weekly chart, and the case for a short was made here. There was a major reaction high back from early 2014 right there. That's resistance. We ran into that level, failed, tried a couple weeks, failed it, and then went on. So that was objective short number one, plus many other short entries on the 60-minute chart, more so to really time our entries. But then I said a break of this trend line would also be trigger a more powerful sell signal, and that's what we did. We're solidly below it. This is why you got to be careful trying to game a counter trend trade in natural gas, because it broke that primary trend line and it came off extreme overbought conditions. I've gone over this again, showed you each and every time you got over that 70 level right here, you can see what happened. Do you want to be long or short? This to me is probably the world's easiest trade. Now, problem is, and that's why we use other indicators. That's why I'll sit here and talk 30-40 minutes in a video and showing you 3-4 charts on a single trade idea, because if you just short overbought on natural gas, well, guess where you shorted it? Right here. And it went here, 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 kept getting more overbought. So I always say overbought is not a sell signal, it's a condition, and usually it's once you cross back down below there, but again, you had other sell signals within there. So that's what you're looking for. You find those overbought conditions, sometimes it's one and done. Hit it and get out, that's all it does. You only have a brief opportunity to get it. But in each and every case there, I can guarantee you there was a reason to go short on the intraday charts, the 60-minute charts, or even the daily charts on these one and done kind of hits of the overbought level. But either way, here's the important thing. We've broken that trend line. And so, if you're new to trading, or even if you've been trading a long time, I warn you, you got to know your security. That's one of my trading rules. I call it know your security. Just like when I used to be a stockbroker in previous life, it was know your client rule. I had to know a client to make a recommendation, know everything about their risk tolerance, their financial situation, liquid assets, you name it. But in trading, I don't do that anymore. Now I trade for myself and do this. I say know your security. What do I mean by that? Well, okay, a lot of people might think, let's measure this out here. Natural gas, since the high not too long ago has dropped. I'm going to grab a measuring tool and tell you that it's dropped. Oh, missed it. Measuring thing pops up to the left. 33%, give or take, right? About 35%. So I'm sure those new to trading said, wow, 35% drop. I got to buy that dip. It's so oversold. Well, first of all, it's not even close to being oversold here on the weekly. You can see the RSI is only at 46. This is oversold down here, 30 or below. And number two is know your security. What happens? Natural gas is a trendy little sucker, I like to say. Quite often, that thing's either going straight up or straight down. And one thing I've learned many times over the years is do not ever underestimate just how far or fast natural gas can go when it wants to rally or correct. So so the point is, the takeaway, if it scares you to go long or to go short, stay away from it. Don't trade this. This thing is, you can call it the widowmaker. But fewer commodities especially can put money in your pocket so fast or take it out so fast than natural gas. So if you get it right, and the key is, don't get married to wherever you think it's going to go. Just use stops if you're going to go long or short. And if you're going to try to catch one of these big trends, you're going to have to use wide stops because the counter trend rallies, even these, seemingly small ones, are well into the double digits. I mean, this is one of the few commodities I know that can easily, and I've seen it many times, go up or down more than 10% in a single day. So if that's not your cup of tea, stay away from it. Trade Treasury bonds or corn or soybean or something else. All right, let's move on here. Coffee, pretty much a dead money trade, not cooperating with me, but not really going anywhere. You had sell signal one here on that trend line breakdown back test. Then another, you put in extended the divergence. So you had a divergent high, you had it here, and it was even bigger here. Then you broke the secondary trend line. You did it impulsively. And now what I'm looking for, we've been consolidating. So we're still below this breakdown right here, below 223, about 240. And we've been moving sideways. So I don't want to spend much more time on it. If you're not in it, probably best to just wait to hold off on this or a rally back to 240, short it there. I do think it's going lower, at least down to 214.90, possibly more. But right now it's sort of a dead money trade. I just wanted to give an update for those of you that might have taken that one. What's next? Cocoa. Cocoa, threw that one out yesterday. And so far so good on this one. Highlight it right here. We had a small but steep bullish falling wedge pattern, positive divergence, everything I like to see, and much more importantly, it was at support on the daily chart. And so far good for, what is that, about a 6% pop into today's highs. We hit the first target there where you could have either took quick profits or raise your stops, at that point, and hold out for a move up to what's my final near-term target. But as I mentioned, long-term traders could make a case for a longer-term position. But commodities have been kind of choppy lately and consolidating after some big gains they made over the last year or so. So I'm still in hit and mode run for most of those. Anyways, there's your update on cocoa. Lumber, not much to add since I threw out that trade idea earlier today. I posted that on the homepage. Okay, so what we have, it's still unconfirmed. We have negative divergence right here on our indicators. We're hair higher. I posted, I think we're at 902 or somewhere. We're right about there. So I calculated the stop based on the target zone. That would give you a stop at about 947 if you're targeting pull back to this target zone. So like everything, this one will be continued. We'll see what happens tomorrow, but that's what I'm favoring right now. You can either cover at the top or just above the top of the target zone, or when it gets close there, lower stops and hold out for the bottom of the target zone. Possibly you can also just lower your stops and see if you get a runner trade. It very well may have another big leg down, and I think so if the stock market has another leg down, because if we get that impulsive selling I was talking about yesterday, we start to get a big drop in the market, we see some of the FANGs break. I need to do a video for you. There are a lot of levels I'm watching. A lot of the FANG stocks hit support yesterday at the close, and so I'm waiting for those levels to break. I suspect they will. I'll cover those in another video. But point being, if we get some impulsive selling, it'll probably take lumber down, because stock market goes down, wealth effect goes down, housing market goes down, things like that, and lumber kind of been doing its own thing in recent years, but usually it is going to follow the stock market to a large extent. So that's that. Last but not least, I threw out Treasuries as a trade idea the other day. Been bullish on them until recently, and more so, I threw out a trade idea on TLT, the 30-year bond. So you have this resistance here. It's been, and you can see it well on TLT as well. This is ZB Treasury, 30-year Treasury bond futures, and that's where we're at. So again, the same case that I made the other day can be made today to short it here, give or take about 162, 295. And then I added this since the last update, a little minor uptrend line gives us this wedge here and breakdown. Now I'll tell you, I'm short the equity markets and long short also Treasury bonds. Now typically they go inverse each other, so I'm considering that a hedge, but it's not a direct hedge. You know, a direct hedge might be, or closer to direct hedge if you're a long Apple, but then you shorted the Qs as a hedge because of the big, you know, they tend to move together. But what happens is the Treasury bond market, and I've talked about this in recent years, has just been, it's changed. Price discovery, which we've had for many, many years, is non-existent now because the Fed is pretty much the only player in town. And now, one thing I'll say, that you know, despite the fact that price discovery has sort of been destroyed by the Fed, yeah, we've had quite a few successful trades on Treasury bonds lately, and from the 30-year, the 10-year, 5-year, I've been calling those pretty good lately. And so where I'm going with this is, look, we could see the stock market drop and treasuries drop, especially the 30-year, because what'll happen is I think you'll see, well, the charts are more clear to me on the 30-year. Let's just leave it at that. I was going to get into talking about what might happen with the shorter term rates, but it is possible. And again, it's all about technicals. So forget about what may or may not happen in the stock market. I might be wrong there. I might be right there, and treasuries may do their own thing. You know, at the end of the day, I talk about correlations and fundamentals and things that may impact, but you know, ultimately I'm only going to take a trade if I can make a clear case on the fundamentals. I'm sorry, on the technicals, on the charts, and sometimes that will directly contradict what I think is going to happen fundamentally. So hopefully that makes sense to you. 152.62 is the level there. You can see it. I've zoomed in on TLT, and that's that same resistance. We've been tapping around this level for a while now. It's pretty big resistance on TLT, and we got pretty stretched to get up here. So now look, we could break out and run, and you know, maybe a big market meltdown that'll happen, and that's why you don't get married to it. Have your stop somewhat above. We have a marginal new high, but look on the indicators down here. This marginal new high in TLT over this previous high right here gives us potential but unconfirmed negative divergence. And so last time I pointed out this divergent low back here in March, and look what happened. We had the biggest rally in treasuries in over a year. So you know, I'm pointing out a divergent high now that could take the TLT down, and that would mean bond prices down, interest rates up. Alright guys, that's it. That's all I wanted to cover in this video. This has been Randy Finney with Right Side of the Chart. Have a great day.